Hi everybody, it's Mark Champ from the Wharf Academy. Today I am joined by Michael Dean, who is director and co-founder of Avamore. Michael, welcome.
Thank you very much, Mark. Thanks for having me, and hello, everyone.
It's nice to have you here. Michael and I have known each other for probably 4 years, 5 years, something like that now.
Sounds about right. Yeah, it's been a good while.
It has been a good while, and we've recently completed a long cycle ride through the length of Portugal, raising money for child aid in Eastern Europe. It was an amazing adventure, and both of us have, I suppose, just recovering after a week of very hard cycling, which was good. Do you enjoy it, Michael?
I thought it was a fantastic experience, Mark, and something that will live long in their memory. Amazing scenery, obviously very challenging physically, and I come away from it with the satisfaction, obviously, of having raised a lot of money for children in Eastern Europe, and specifically Ukraine, but also a great love for the country of Portugal. So much so that I'm going back next Saturday. So,
Wow.
looking forward to that.
Excellent. Well, I'm glad you enjoyed that. But today we're here to talk about property investment, development, financing in particular. Michael, you were the co-founder of Avamore. Do you want to tell us a little bit about Avamore and how you set it up, why you set it up, and what the journey's been like so far?
Yeah, thanks, Mark. Be very happy to do that. Avamore was founded 7 years ago by myself, Zaher Mirza, and another colleague, Nick Petkov, who's no longer with the business. The origin behind it was that I was doing investing family capital. I'm a surveyor by training, specialised in commercial offices, specifically West End and City of London, where I was a surveyor and I was doing leasing and investment. And then I moved into a private equity company around the time of just after the financial crisis, where I did a lot of debt restructuring. So I developed quite a lot of experience and skill in the debt space there. And then I started working with my father-in-law about middle of 2011 to invest in commercial properties. So we bought a load of commercial properties around the M25. We also sold his healthcare business, reinvested that capital into these commercial buildings around the M25, which we got planning for, or we got PD for, and sold to a number of developers. During that time, we were fully invested at certain junctures, and I was working as a bit of an advisor to a couple of developers, helping them raise some capital. And I stumbled across the bridging market. Nick Petkov was working for our family at the time as well. And the office building that we were working in, the guys who sat behind us had a double dating app, which actually got some money from Peter Jones on Dragon's Den. But one of the founders there, his best friend was Zaher, suggested that we speak. Zaher had just left a large investment bank where he'd been for about 7 years and was looking to get into real estate, and had done a few bridging loans of his own. So kind of fast forward, Zaher and I looked at a couple of deals together to fund some of the developers I was working with. And through those conversations, we kind of established that we saw the world in quite a similar way as far as investment and risk. We kind of, between myself and Nick and Zaher, we came to the conclusion that setting up a bridging lender would be a good idea. Zaher coming from a family office background, and myself obviously coming from a family office background too, we started to recycle our family's capital into bridging loans, and we started to write loans of our own. And that was, mildly successful, but obviously we had a limited pot of capital to play with. So we started to do some club deals with some other high net worths and other families, and that was something we continued to do for around 2.5 to 3 years. And then we started to attract the attention of a couple of American credit funds, and we agreed terms with those US credit funds to start to originate for them. And really from there, the business is really hockey stick. So we went from 3 people in the beginning to, I think, not long ago, we're about 32, 33 individuals. So a significant increase in headcount. And we went from lending 20 million in our first year to having ambitions this year to originate something in the region of 275 to 300 million pounds worth loans, and we're managing something in the region of £250 million worth of bridge and development loans. So that's kind of that's kind of our genesis story. I don't know if you want me to elaborate any further than that, Mark, but
well, it's interesting because I've been in lending for a long time, not from a bridging background to start with. It all started from the high street for me. So bridging was quite far away from what I was doing. And to be honest, I didn't really know too much about it until I joined Shawbrook in 2015. But you guys, I knew of pretty soon after that, because back then we were even losing deals to you on the bridging side, and the refurbs and all that type of lending. So for me it's interesting because I class myself as a bit of an entrepreneur anyway, and thinking about how you can go into different revenue streams, setting up a lending business must be quite different from setting up a brokerage, because when you set up a brokerage, you don't have many overheads, you're not risking too much capital. But being a lender, that's a big risk to start, especially with your family money. It must be quite daunting when you set out on that journey.
I guess one of the benefits that we've had is that both Zaher and I are relatively, I guess we're relatively sophisticated, both having worked in quite high-paced financial services businesses. We've also had the benefit of knowing some good lawyers, so they were able to guide us. Ultimately, I've been trading in real estate for now the best part of 10 years, and then had experience as an employee in a number of places. So the way that I saw it was that I could either take 100% risk exposure on a commercial asset, especially at a time when there was a lot of uncertainty. We founded the business just before the Brexit vote, for example. So I could take 100% of the exposure, and sure, I get all of the upside, but there's a lot of downside risk there as well. Or alternatively, I could sit at 70-75% of the exposure, and then if the market went down, then our position would be quite comfortable, and we'd have a more guaranteed return. So I think coming from the background that I had, I didn't necessarily see the risk in the same way. The sort of way I looked at it was, and not that this was really ever a strategy, is that would I be happy to own the debt exposure I have? Would I be happy to own that asset at the exposure I've got? And invariably, that was the reason why we were able to get there. And I think that possibly some of the reasons why we would win some deals in the early days was that we were willing to be creative with structuring, and I think we continue to do so to this day. And then I think we were also willing to take a bit more of a view on value at the time on certain situations, which probably meant that we got to punch above our weight in the early days. But naturally, once you start to bring in external capital, that becomes a little bit more challenging, and you have to become a bit more mainstream and operate more in line with how other people in the market operate.
Yeah, it is interesting. You mentioned about when you get the credit lines in. We've seen quite a bit of press about credit lines being pulled, and we've seen a couple of bridging lenders that are pulling away from the market in the last couple of days. Does that worry you, that credit lines can disappear, and how do you make sure there's a certainty of the funds coming in?
Well, I think to answer your second question first, I don't think there ever is any certainty, and anyone who tells you that their money is absolutely rock solid is either lying to you, or that they are or they're a bit delusional. Because and the reason I say that is because ultimately, whoever you borrow from in the market, whether you're getting your money from a Shawbrook or a Lloyds Bank, or whether you're getting your money from us or a private lender, pretty much everyone is getting their money from approximately the same source. And the factors that influence the appetite of lenders and the people that fund lenders are broadly similar. And yes, you might see, in the case of rate rises, you might see a slightly delayed response from some people because they want to keep market share, or and they're willing to take a hit on margin, or that they've got arrangements in place which with their wholesale funders which delays the implementation of any increases in rate rises. That could be one thing, or from a or likewise from a credit perspective, where they have mechanisms. But ultimately, over, let's call it a 6 to 8 week window, if there are changes in wholesale markets, the net result is most of the market will respond accordingly, and you will see over a 6 to 8 week period a harmonization where everyone is roughly impacted in a similar way. As far as the lenders that are pulling back or withdrawing from the market, we know a lot of these people. We have similar funding sources to some of these people, and we know we understand the dynamics at play as to why those people have found that their funders have walked away from them. I think one of the biggest challenges that wholesale funders are experiencing right now, and I think it's not that widely known about, at least by property investors, it's probably better known about by people like you and me who are, I guess, at the coalface as far as the financing world is concerned, is that, the securitization market, particularly in the States, has ground to a halt for what you would probably term to be the less, the less secure, more risky mortgages, whereas you probably can still securitize residential mortgages and higher quality buy-to-let. I think OSB just completed a securitization this week. I saw that was announced, which I think is a really positive sign. One of the challenges I imagine OSB would have had is that the pricing that was applied to that would have been significantly higher than it would have been 3, 4, 5 months ago, and that obviously that presents challenges operationally, because how do you market a product at say 3.5% when you then have to sell those loans at 4.5%, 5%? If that was where the market moves over that period of time, when you go from originating to syndicating, it's a challenging feat. But at least that market remains open for buy-to-let lenders. I think for the people that provide wholesale funding lines for bridging loans and development loans, the appetite from capital markets, especially in the States, and ultimately that is the deepest pool of capital that we have globally, having shrunk significantly to the extent that some people, that market essentially is shut. There's less money to go around, and we, obviously being funded by American funders, we have conversations with the people there, and they're saying to us, look, whereas before they might have been looking at an 85 or 90% loan to cost construction loan, and they would have bought that at 6 or 6.5%. They were able to do 75 loan to cost and sell that at 9.25. So that tells you that there's been a big shift in the amount of liquidity in that market, and those funders have gone from being, price takers to price makers. They can almost set the price that they want to take that for. So, understandably, wholesale funders, if that's the position that they find themselves in, they're going to be more selective, and they might also be looking at 2 to 3 months time where they're looking at opportunities to lend at even higher rates and potentially on lower risk stuff, and they can be more selective. So look, I think that from a wholesale funding perspective, these are the dynamics at play. Now, what we find, and one of the reasons we, touch wood, we've maintained very successful relationships with our funding partners, and why our funding partners continue to support us when they've maybe paused their support for others within the market, is because we've become their primary partner in the UK, or one of their primary partners. And the reason behind that is we're very focused on their needs, and we try to understand their requirements, whether that's in terms of price or whether that's in terms of credit appetite. Our credit performance is stellar. We've never lost money on a single loan. We even were victims of a fraud on a loan, and we managed to recover that through an insurance policy that we took out with a company called Westcore, who did a fantastic job, and we have very high praise for, and they're well known within the market for doing that. It was the only time we've ever had to use them in 7 years, which in many ways is a bit of a rarity. So we have a very, very good credit performance with them. We've also delivered incredibly good returns for them as well. So and the other thing is we have scale with them. So I think a lot of our peers would, if you excuse the expression, tart themselves about, and they'll take money from whoever is the cheapest going or whoever's giving them the highest advance rate going. And we don't really take that approach. Our approach is we want to be meaningful and significant to our partners, which means that we need to have a loan book with these guys of at least £100 million, or work up to a loan book of £100 million, in order that we have a significant strategic position with them, and that they feel meaningful to us, and that we feel meaningful to them. And that therefore provides us with, in theory, it's never a perfect theory, but in theory, a degree of insulation. And that ultimately these wholesale funders, they want to keep their key partners going, because if their key partners fall down, then they have to start their origination all over again. If they choose to just hit the pause button uniformly, and then start again, 3 to 6 months later, kind of a bit like what happened in COVID with a lot of these wholesale funders. I think they may have learned the lesson from that, which is actually, if we just keep originating, but at a lower volume, we can keep our key partners going, and that when we want to turn the taps back on, we can access the market much quicker. So I think that's the theory. And certainly when we look to take on new funding lines, our approach is, if we want to take on a new funding line, first of all, we need to be able to achieve the same level of scale and significance that we have with our existing lines. And secondly, any new funding line we take on has to be complementary, namely that we want that to be doing something different that our current funding lines aren't offering, so that there isn't that, there's always going to be a degree of overlap on the margins, but ultimately we don't want new funding lines cannibalizing old funding lines. We want them to, we want, rather than, slicing up the same size cake, we want to be giving everyone the same size portion of a much larger cake.
Yeah.
So hopefully, I know I've spoken for a long time, but hopefully that's clear.
No, that does. It really does give everybody an insight into what goes on in the background. But for a customer looking to take a loan out, they've got a project where they want to do a renovation or whatever it may be, should they be asking how secure the lender is and where their funding lines come from? Is that something that do you think the customers should be asking?
Well, if not the customer, I think the customer's broker should be asking that question. They should have good visibility around that, because the last thing you want to do is have a client sign up for, we both know, Mark, that the due diligence cost of a lender can amount to tens of thousands of pounds, depending on the size of the project. Mm-hmm. So do you want, and I'll give you an example. We actually bailed out a broker colleague of yours in January, when a lender started writing checks that they couldn't cash, and they committed to a £11.5 million bridge facility to help a developer take themselves out of a kind of high rate private equity operator that was that they'd had a significant falling out with, and they needed to get out of there as quickly as possible. And this lender didn't have the funds. They couldn't perform. And so 1st of November, I was told, look, I need to, can you get us out by X date, because so and so have let us down. Well, that lender, who no longer exists, I might add, they've been shut down. So I could name them, but I'm a professional, Mark, so I'll just I'll decline the opportunity. They had accrued £50,000 of the legal bills and a further £15,000 of valuation fees. And it's a big transaction, right? Of the client's money, and for a transaction that couldn't proceed. And that was dead money, dead cost. So I would say certainly you do need to have some confidence and some comfort that your lender can perform. If you're a broker or a borrower, how do you foresee a situation like that? I mean,
yeah, it's impossible. It's an impossible situation. I remember talking to somebody about investing in shares back in, it's just like 2006, 2007. They were saying, oh, I want to start investing in shares. What should I invest in? And I remember saying to them, I said, look, I'm not an advisor, and I'm not qualified to do anything. I've always invested in the banks because, the banks are well capitalized, they make profits, and then the crash happened, and it's you can't see things. And I think the long relationships are what actually should give comfort to customers. When you can pick up the phone and understand what's happening, and also have the network and the ability to move things if you have to. So if we have a lender that unfortunately can't lend anymore, we can go to X, Y, and Z to fill the gap. And I think that's really, really important from a customer's perspective, not just going maybe with the first broker that they meet at a networking event who says, I can get you, the cheapest rate in the market, because the cheapest isn't always the best, as we know.
I mean, look, you guys as brokers have how do you differentiate yourselves, right? When you're trying to get in front of a new customer? I think a lot of your peers, Mark, and I don't think this is something that you do, because I think you're very much focused on performance and relationships. But a lot of your peers are very, they try to sell themselves either on rate or on leverage, and the fact is that's probably not the best way to go about things, because a lot of the time lenders, I know we've just been refinanced on a deal by someone. It was a fairly large exit bridge. They quoted a ridiculously low rate to the broker, and the client decided to refinance away from us to go with this particular lender. I mean, the rate was so low I couldn't believe it was real. But when I spoke to the broker just before the refi completed, and as a broker we've done quite a few deals with, he's a great guy, and we'll do much more business with him in the future. And I'd warned him that I'd heard a few things on the grapevine about this lender. I know a couple of the guys there. I like them as individuals, but so it was kind of news to me that these guys had this reputation. And one of the things that they had a reputation for was moving the goalposts in terms of terms, but also they didn't really have the experience to understand how to do a complex exit bridge. There were certain aspects of the title and the planning that needed someone with a real development expertise to get their heads around it. And it ultimately cost the client a fair bit of money extra because of the delays, because these guys didn't perform. And the broker had said to me that he was actually amazed that they didn't. He thought that he was going to get the phone calls to say that they were going to go from X rate to Y rate because of the complexity of the case towards the end, and they didn't. So I think your approach is absolutely the right one, which is focus on performance delivery. The guys that have performed for you in the past are the guys that will you've seen them walk the walk and talk the talk. And I have to say, like, as a lender, who's been kind of in the ascendancy, trying to make a name for ourselves in the last 3 or 4 years, particularly since we've had a depth of capital that's enabled us to do so. we've definitely had the most compelling product in the market. Like post-COVID, we probably had the best refurb product in the market. But we couldn't elbow our way in to a number of the relationships that already existed between other lenders and brokers. Because ultimately, as a broker, Mark, many of your clients, they'll be with you for 20 years, but they'll only be with you for 20 years if you keep providing them with good quality service, with lenders that perform and don't screw them over. If you put a developer into a lender that messes them around, delivers delays, cuts leverage, increases prices without justification, I guess, Bank of England base rate rises are probably you would exclude from that. I think you probably lose that customer, and then you're potentially losing another 10, 15, 20 years of business from that customer.
It's interesting you say that. Just on that point, we've had a customer recently who has been very disgruntled by the lender, really not happy with the lender. And to be honest, we disagreed with the customer. We disagreed with their thinking and their reasons why they believed the lender wasn't performing. And we stuck up for the lender. We said, actually, do you know what? We believe the lender's doing everything they can, and the solicitor's doing everything they can. They're being open, honest, they're talking to us. And we really push back on it. And, if we lose that customer, fair enough. But we found the relationship with the lender was just as important as the relationship with the customer there.
Look, I don't want to say that you're relatively unique in that regard, Mark, but I think that ultimately what you'll do your client a disservice by just being a yes man. If the client says, these guys, they're terrible, they're doing an awful job, you're doing your job properly if you're saying, well, actually, I've looked at everything, and actually what the lender's doing is appropriate. Easy for me to say as a lender, but look, you and I have both experienced both as lenders and on your side as a broker. There are always going to be unreasonable people. There's always going to be people who are just used to getting their own way, and that and to be honest with you, they're probably more hassle than they're worth. So if they don't come back to you as a client, then you've probably not lost an awful lot, because if you weren't going to fall out with them on this deal, they'll probably fall out with you on another deal. And we've got a deal right now which is about to go into receivership. We've only had, I think, 5 receiverships in 7 years, so it's not something that happens very often. Incredibly wealthy guy, thinks he can push people around. When we completed the loan, or when we were about to complete the loan, he tried to cut the broker out, reduce the arrangement fee, and cut the broker so he could cut the broker's proc. And we said, no, we can't do that. And subsequently, he started doing the foundations, the piling, and then he then refused. We funded the drawdown. He's refused to pay the piling subcontractor, and the piling subcontractor is now threatening to go back on site and rip the piling out. So sometimes these people, they're just not worth. Was the expression I heard not long ago? When someone shows you who they are, believe them. That's kind of that's kind of the adage. These guys, they're showing you that they've got that they're not that they don't have any that don't have any integrity. You probably should try to avoid doing business with them.
Yeah, I think you're right. I think you are right. Well, we're going to have to wrap it up here, as we've spent a long time talking about what happens in the background for lenders. So thank you very much. We obviously know Avamore as a bridging, but more on the development exit and now the development side. I give you guys a massive thumbs up, from the people I talk to every day all the way up the line to you guys who've started the company, and the background staff. Communications there, products are there, the ability to complete. And the thing I like most about it is when you are in process, you are chasing constantly, and you want to get the deal done. Everybody in Avamore is working together to get that deal over the line, and even the customers are like, God, I was going to use the word pushy, but that's the wrong word. You are moving it along the line. You're getting that efficient process, and that's what customers crave so much. So I think that's your biggest USP, the pushing it along the line very quickly, which is great. So thank you very much.
Thanks, Mark.
No worries. Thank you very much for today. Really appreciate it. And hopefully we'll catch up again soon, and maybe there'll be some changes in the market and some more opportunities. So thank you very much, Michael.
Yeah, Mark, thank you very much. Thank you everyone for listening, and yeah, look forward to coming on again if you'll have me.
Excellent. Thanks a lot, Michael.
Cheers. Thank you.